So in the last few weeks, I've seen a lot of traction to Grab stock, especially on the X platform. Everybody seems to be talking about it. But as the clue in the title says, I do not like this stock and I don't understand why people are looking to buy it. Now, they did report earnings last night and we're going to take a look at them and I'll go through the reasons why I do not like this stock. But it seems to me that a few people are looking at this as the next growth stock, maybe retail investors trying to find the next Hims and Hers, the next SoFi, the next Palantir. But unfortunately, I think this stock is way far off being one of those stocks. I don't like it, and today I'll go through the reasons why. Hope you enjoy the video, hit the like button, let's get started. So Grab Holdings has had a pretty okay start to the year, up 12%, but as the stock opens up in pre-market, it is going to give away most of its year-to-date returns. And actually, when you zoom out a little bit, it hasn't been a good time for Grab Holdings. Since the IPO in 2020, the stock has had a tough time, and since its IPO, the stock is down 56%, and it will actually be down more as the stock opens up today. It is a 21 billion market cap though, so it's definitely not a small company at all. Now, I have actually previously covered this on the Patreon. We did a stock request on Grab and I gave my thoughts on that on the Patreon, but I thought there's been so much talk about it on YouTube, on the X, about this being an opportunity in the market, and I could not disagree more. And I thought today I'm going to make my thoughts public, as not just being behind the Patreon paywall, but I also want to make them public that I don't like this stock. So like I said, they did report earnings last night. Clearly the market is not liking their earnings. Basically the EPS came in line. The revenue was 17% growth, but was a miss by 12 million. And I think a few people are pointing at the guidance and they're not really liking the guidance and were maybe hoping for a stronger guide there. Now, looking at their earnings from last night, we'll have a look at the numbers. If you don't know what Grab is, basically it is the likes of Uber. It offers a delivery platform, like a food platform, and then it also does a ride platform as well. There's also a bit of a finance platform that we'll look at in a second, which is a little bit different to Uber, but mostly it's like Uber, with most of the revenue coming from the likes of a delivery platform, food delivery platform, and also the taxi service. Now the difference is that it operates in the areas of like Indonesia, Malaysia, Philippines, compared to the likes of Uber that doesn't actually operate in those sort of areas. Now as we go on the first slide, we're already hit with like the majority of the reasons why I don't like this platform. So revenue growth of 17%, 15% year over year on an FX neutral basis. Now I personally think this isn't, I think a lot of people call this a growth stock. For me, a growth stock is not a company, well, it's very good growth to be fair. A lot of companies would be liking to grow at those sort of rates, but it's not standout growth to me at 15% year over year on an FX neutral basis. Now, this is also a big thing that kind of comes in straight away, is the FX impact. So with a lot of these companies that operate in these sort of areas, you've got to be careful, because quite often, because of the currencies, and then they have to go report in US dollars, sometimes the FX impacts can completely wipe a lot of these stocks out. I've seen it before with some of the stocks that I own, but as well as that, I do own stocks in this area, but I tend to go with stocks with a lot more growth than this, because if they were to have an FX impact, what they're able to do is still outgrow this FX impact and show growth. What we can see when you're only growing about 15% growth, a big FX impact can actually wipe out a lot of your growth on a reported basis as you go and convert those earnings into US dollars. So one thing I don't like is the slower, not really standout growth here, but also then you've got the FX impact as well when you're operating in these sort of countries here. Now the revenue is also lower than the gross merchandise value, which is not what you want to see. And the other thing as well is when you look at the adjusted EBITDA, 97 million, adjusted free cash flow of 61 million. Now, yeah, these are showing like they're going up in positive directions, but the problem is that we're going to have to go back to the market cap here. When you actually look at the value of Grab, we were talking about a 21 billion market cap company. A 21 billion market cap company that is currently doing 97 million of adjusted EBITDA and 61 million in free cash flow in Q4. That is not great. That is not great. And that's when you also look at a forward earnings basis. On a forward earnings basis, Grab is currently 133 forward times earnings. Now, sometimes you don't mind paying a premium for some growth companies, But when you buy it in a premium for growth companies, you're expecting big growth numbers where they grow into that valuation very quickly. In my opinion, with the limited profit that's coming in with this business, and you also look at the growth, this is not growing into this valuation very quickly. So that's the other issue. You've got not fantastic revenue growth, you've got the currency impact on top, you've got very low amounts of profitability and profit growth for the valuation, and also the valuation is incredibly high. Now the issue as well is when you look at the business, is you look at the delivery part of the platform. This is the biggest part of the platform. You can see here 407 million in revenue. Compare that to the taxi side of it, 282 million of revenue. Now the problem is with the delivery side of the platform, and I think it's exactly the same with Uber, it is so hard to make money on deliveries. And in fact, that's where you look at the adjusted EBITDA part of it. There was no growth in the adjusted EBITDA part on the deliveries. Now your biggest part of the platform, not showing any signs of improvement in the profit side, is worrying. And as well as that, the gross merchandise value was up 19% and the revenue was massively lagging behind it, and the EBITDA was lagging behind the revenue. All of these metrics are massively concerning to me. And the most profitable side of the business is the ride, the taxi service. You can make more money on rides rather than delivering food. Now, like I said, it's a smaller part of the business, but same again, we saw gross merchandise volume up 23%, but it translated into slower revenue growth of only 17%, but you can see here they are making more profit from them. The problem is this is a smaller part of the business. When we compare that to the likes of Uber, for example, Uber's biggest part of the business, the revenue from the delivery side of Uber Eats was 12 billion, where its revenue from its ride-hailing side was 19 billion. So Uber gets more revenue from its ride side than its Uber Eats, and that's how Uber is able to get more money, because it's a more profitable part of the business. The problem you have with Grab at the moment is that's not the case. It's the other way around, which once again makes it harder for them to make profitability when your most profitable part of the business isn't your biggest part of the business. And your biggest part of your business continues to have revenue growth slower than your gross merchandise volume, and also your EBITDA is not growing much on that big large part of the platform that you currently have as well. Now what a few people point out when they talk about Grab is they go, well, it's got a financial services. Now I think it's so weird that a taxi service company has a financial arm. Why would you want a business that is focused on food delivery and taxi service to be offering a financial services? Is the knowledge best served there? I don't know. But a lot of people point this as the growth driver. Well, yeah, it might be a growth driver, but the problem is it only makes up 74 million of the revenue. This is a very small part of the platform, less than 10% of the revenue, which isn't anything massive at the moment. Yes, it's growing, fastest growing part at 38%, but it's nothing crazy growth here. I would expect to be seeing a lot higher growth than this. And yes, the profitability is moving up in the right direction, but this part of the platform that everyone's pointing out as being the growth part of the platform is still losing money. So it's not like this is going to, as it keeps scaling up, is going to throw big amounts into the profit side of it, because it's yet to turn a profit at the moment. So that would need to show me that this platform here would need to get, you'd have to judge this in another 2 or 3 years time, when you still see, is the growth growing at good rates, and actually is it going to contribute to any profitability, because at the moment it's not exactly doing that. Now the other thing as well is that Grab offer incentives, so a little bit different to sales and marketing, because sales and marketing obviously is a great way to promote your product, but Grab do it through a little bit of a different way, which is very similar to sales and marketing, but it's called incentives. It's one of those where you go on your phone and you go on a ride and you say, oh, because you did this with us, we're going to give you this discount, or if you take this ride now, or if you order this food right now, we're going to give you this sort of discount. Now the problem as well is with a lot of these incentives, the incentives keep going up, and they're not even going up at a slow rate. Like, these are growing nearly towards 30%, which is not good, which once again, especially when we compare to the gross merchandise value that's translating to the revenue, would suggest there's competition, and that is the case. There is a lot of competition in this space. There's probably more competition than what even Uber had, which is not great. Now there's no updated kind of market share metrics here. The last one I could kind of get from a Singapore region was in 2022 Q1. But you can see here there is a big fragmented market here of people trying to come in and take this space. And when there's competition, it's very hard for you to make more money, to charge more, to make more profit, because if you put your prices up, well, what's going to happen is that people are going to go through Grab and then go for one of the other alternatives. And that's why you've got to have big marketing spend. And in the future as well, until this is resolved, it's going to be very hard for them to make money. Now, the benefit that Uber had when they had it is that eventually they managed to beat all the competition down, but they had less competition. And what happened in 2022 is the stock market absolutely sunk and Wall Street went, you need to focus on profit. And Uber and all the other companies in this space, which was really only Lyft, were all forced to put the prices up so they made money. So will that ever happen in this market? I don't know. You could argue the case it's more fragmented market. The other issue is that Uber operates in a richer economy. Now, because they operate in a richer economy, Uber, they can charge more on the taxi rides. So you make more revenue, you can make more, the rides cost more, you can make more profit on that amount. Because you're operating in a better economy, you're able to make a lot better financials. The problem that you have as well with Grab is because of the areas that they operate in, it's a lot different from the US. You're working in countries that are as not as strong as the likes of the US. So the average like taxi fare that you'd be looking at potentially in the likes of these regions of like Singapore, for example, Malaysia, the taxi rates are so much lower. So for them to make the big amounts of revenue is a lot harder because the fees are a lot lower. And then the profit you can make on this is also a little bit weaker as well. So you've got competition and you've also got just in general a weak economy to make money from. It's just not attractive in my opinion. And like I said, you know, for all this risk that you're taking on here, you're paying a 21 billion market cap valuation for it. This isn't valued at like a small upcoming business. This is already valued at a pretty decent sized business. And for all this risk, you're taking it on at 133 forward times earnings. It's just, I just don't see the risk to reward here. For 133 forward times earnings, I would have expected to be looking at the financials and seeing revenue growing at, 30, 40+%. I would expect to see profits scaling up massively during this time frame. But for me, all I see is concerns around the business, and those concerns are not really improving in my opinion, and it just doesn't seem attractive to me. There's so many risks with this business to the valuation you're paying up for it. I personally think, it's a massive avoid for me. And people are calling it, the potential of being the next kind of Uber. Well, I would say that I think it's got a long way to go if it wants to be the next Uber with dealing with some of this competition out here. The fact that its most profitable part of the business, the ride part of the business, is a lot further behind its food delivery service like what Uber was. Like I said, a lot more competition. I'm not a fan at all, and I don't see the hype at all with Grab. I think there's so many better opportunities for the value in the stock market right now. It's personally one that I'm not touching anyway. So I hope you enjoyed the video on Grab. I was going to do a few other videos because there's a lot of big news coming up tonight. Obviously the Alibaba earnings as well, but I thought this would be a good one to do because it seems a really talked about one at the moment, and I thought I'd get my thoughts out there on Grab Holdings. So thanks for watching guys, see you in a bit.